globe. The Dow was down over 300 points. The GIFT Nifty was also suggesting a fall. That's the first tick on the index, by the way. Absolutely flat, but a little bit of a positive bias. 20 points higher on the Nifty. The Bank Nifty is down about 70 odd points. So the Bank Nifty is dragging its feet a bit. Dragged lower by HDFC, ICICI Bank, IndusInd Bank and Kotak. So all four top banks are trending in the red at the moment. Now the Nifty and the Sensex have also moved into the red. The top losers are some of the consumption names. So Tata Consumer, Titan, HUL, Britannia, all in the red right now. M&M is also down about 0.5%. So looks like a little bit of profit taking is what we're seeing. On the upside, Maruti Suzuki is your big gainer. Remember, the numbers were very strong. There was a big beat in earnings, a lot of brokerage upgrades. Maruti Suzuki holding up. Reliance, good set of numbers coming through, better than what the street was estimating. Stock is up 1%. Cipla, the company has raised their margin guidance. Stock is up about 1%. And Ultratech Cement as well, hanging on to the green line. SBI Life too is up almost about 0.6%. So these are the stocks that are batting for the bulls this morning and making sure that the Nifty stays above the 19,000 mark. In the broader markets, Nigel will speak more about that, but the stock of the moment undoubtedly is M&M Finance. It's down 8% on the back of weak set of numbers. Generally, M&M Finance has, a more ferocious move to its earnings, depending on which way the earnings go. So this is quite alarming. 8% down now on M&M Finance, but otherwise, just don't lose sight of the market. It's now falling. The Nifty is now down 50 points. The Sensex is down 150 points. So, as we were saying at the start of trade, there's nothing in this market that is enough for the market to sort of stop the falling trajectory and not looking good at all.
Well, that's right, Sonia. From the broader markets, let's try to highlight some green. You have Piramal Pharma. After a while, they've delivered good numbers. Margin improves, debt reduction as well out there. So the street believes that valuation support is there. That stock is up close around 7%. So that's the big mover. CDSL, the stock is up close around 6%. Volume's massive out there. You have Welspun India as well. That's up close around 5% as we speak. On the flip side, Mahindra & Mahindra, as Sonia said, Mahindra & Mahindra Financial Services, now it's down close around 9%. You have Ujjivan Small Finance Bank, that's down close around 2%. And IDFC First Bank as well is down close around 2%. Add to the list a couple of other notable big movers. MGL, those numbers look good. Sonal told us about that. That's up close around 6%. Union Bank as well is up close around 3%. Cipla seeing some follow-through, buying up close around 2%. And Indian Hotels, they came out with their numbers late on Friday. The commentary seems to be good in a seasonally strong quarter as well. Quarter 3 is going to be good because of the festivities and also because we have the World Cup. A few more stocks that are losing out. SBI Cards, that's down close around 5.5%. Later today, I think at around 11 a.m., we'll have the management who joins us on CNBC-TV18. And India Mart as well has pulled back close to around 5%. So earnings reactions quite mixed is what I can say.
All right, well, Nigel, 40 points lower on the Nifty is what we have. And we are exactly at that 19,000 level on the Nifty. So this is very much a market to still be watchful of. The Nifty Bank, by the way, which is the weaker of the two, clearly, actually it's the weakest of the headline indices. That is down 0.4% or so. So that is underperforming straight off the bat. Early, but maybe take a look at the mid and small cap indices as well. Mid cap index is down 1/3%. And the strongest part of the market has been the small cap index, which is down about 1/3% as well. Yeah, so it's, a little bit of pressure which is coming through. Let's just look at AU Small Finance Bank, the acquisition announcement, of course, and the conference call in the morning today. AU Bank is now 1.5% lower. I think, some repetition, but some new stuff. CDSL is up 6%, reported strong set of numbers. It is the largest volume traded gainer across the board on the NSE. So CDSL is up at about 1,400 plus. There is Union Bank, which again reported numbers, 2.5% higher on Union Bank. Sonal was talking about MGL, Mahanagar Gas, and the numbers there, 5% higher, 1,040 on MGL. There is Piramal Pharma, which is up 6.5%. Again, huge volumes on these names, almost at 100 rupees now. That is Piramal Pharma. There is, what else? Satin Credit Care, right? The microfinance name. I'm only mentioning it because it's got decent sized volume. 7% on Satin Credit Care coming through. I don't know if they came out with numbers, but 246 on Satin. I think they did come out with numbers. Sterlite Tech and a few others. But, volumes then kind of are not all that great. Pull up the advanced decline ratio. We were positive. And it suddenly flipped completely. 1,200 down and 740 stocks higher now. That is the overall market breadth, which is sort of moving around and completely changing. I think Nigel mentioned M&M Finance. IDFC First is another one, which I think there's been a bit of a disappointment, some earnings cuts, etc. 2% lower on IDFC First. Mazgaon Dock is down about 3%. BSE was the strong stock through this correction. BSE, Bombay Stock Exchange, is down about 2.5%. SBI Card is 6% lower. But Abhishek was just telling us about the numbers there. Angel One is up 20% over the last 7-8 days. When the market is corrected, Angel One is seeing some profit booking. It's down 2% or so. And there's a lot of stuff which is coming into the mix now. But the Nifty, Sonia, is down about 12 points or so.
I just wanted to make one mention on M&M Finance. It's now down almost 10%. And, you know, Abhishek was also telling us that the numbers this time are very weak. In fact, I think the net interest margins have come in at a 3-year low for M&M Finance, and asset quality has also deteriorated. Remember, the 52-week low for M&M Finance is about 191. So we're still a little far away from that. But, you know, I mean, this is quite alarming. Is it only an M&M Finance issue, or does it extend to the entire sector? We'll have to wait and watch.
You know, earnings for M&M Finance for many quarters now.
Very volatile.
It's mostly been on the sort of, you know, they've missed expectations. But as Abhishek said, when the FY25, I think, guidance is intact and the management saying they're on track to achieve it. Let's welcome in our market master of the day. Tahir Badshah is Chief Investment Officer at Invesco Mutual Fund. Tahir, good morning. Good to have you with us here. Thank you very much for your time. So let's just start with earnings, Tahir. What are you making of the earnings so far, and what's standing out for you? Any trends, any threads you want to pull on, which gives you a sense of which way, which parts are doing well, which parts are weakening? Go on.
Yeah, so I think we started off as usual with the tech pack, and that was obviously something which was a little mixed in my view. I think it once again probably gave it a feeling that we need to look at it a little more from a more longer term perspective. Things can get pushed back a little bit more than what we had anticipated. So, but even within that, then I think some of the mid caps clearly stood out and managed to deliver some better growth compared to some of the large caps. So there was a mix out there too. But in general, I think I felt that things could probably take a little longer there compared to what was our expectation earlier. Followed by the banks, which in general have done quite okay under the circumstances. I think NIM pressures, which were evident as usual, as was expected. I think more recently within the BFSI, particularly over the last couple of days, we've seen some segments and pockets where we've particularly on the retail side, we've seen a little bit of stress. And that's something which therefore becomes a monitorable from here on. So we've seen it in multiple forms within the BFSI segment, and particularly in the NBFC space. You called out a couple of names in the recent times as well, just a while ago. So I think that's how it has been. But by and large, I think it's been reasonably decent. We've seen some auto results which have been quite good, although near-term trends in terms of festive season, etc., still need to be monitored. So I think the December quarter then in that case will be crucial. We have some bit of ground still to cover within the result season, but by and large, I think it is still pretty much a decent inline result season up until now.
Okay, by the way, the stock of the moment on the upside is Cipla. It's 3% higher now, and despite the rally that we've already seen, brokerages have very ambitious target prices. Cipla is the one I'm talking about. Citi has raised their target price to 1380 on Cipla, so that's still much above the target price. And, people I'm sure are very excited about the weight loss drug, semaglutide. By the way, Cipla is going to launch it in its oral form in India. So that is, I think, the big excitement. But I want to tell you, Prashant, that there are a lot of side effects. Nausea, diarrhea.
Oh, yeah. And by the way, those are only the sort of, garden variety side effects. There are more serious side effects as well, which sold, the brand name is called Ozempic in the US. And they actually, there's a black box side effect warning, serious stuff. I mean, so you've got to...
Absolutely. Yeah, I mean, and it's gone viral as well in the US. So... well, got to be careful here. But Tahir, hi, good morning. How are you feeling about the market now? There is, of course, this geopolitical crisis that we have to deal with. Do you think that this is a good buying opportunity for long-term investors, as has been the case with earlier geopolitical issues? Or are you a bit more cautious this time?
Yeah, I think I continue to still maintain a very positive view as far as the market is concerned, particularly from a domestic standpoint. I'm pretty constructive. I take a lot of confidence in the investment cycle, which is currently in progress in the country, and I think that can extend itself. Yeah, I mean, intermittent volatilities, which we witnessed in the last some time, should clearly be considered to be investment opportunities. We were expecting a lot of volatility along the mid and small cap space, but actually, if you were to probably wind back to the last 1 month or so, the small cap space has probably actually stood out the best. We've seen a lot, relatively more pressure on the larger caps, probably the Nifty as well as the mid cap index, which are down about 4% versus the small cap index, which is relatively flat. So I think there is a message in it, in the sense that there is a fair bit of activity at the ground level. The domestic economy being strong is actually widening the set of opportunities and probably bringing in more domestic-oriented businesses into play. So from a portfolio standpoint, yeah, I mean, we do try to keep a little more focused towards and tilt towards the domestic stories. That's why we continue to find opportunities. So in general, relatively more constructive.
All right. Hi, Tahir. Good morning. Talking about the domestic stories, the BFSI space actually, if I look at earnings for the last few quarters, last 2 quarters, the earnings cuts have not happened in BFSI or in autos. They've had in other sectors. So in terms of earnings visibility, the BFSI space is placed quite well. The problem is, though, it's been underperforming. What's your view out there? How do you approach this sector? Earnings visibility is there. You have return ratios that are looking good. Offtake has been looking quite good. Credit offtake as well. But still, that space is underperforming. Your take?
So I agree, Nigel. I mean, there's been a frustrating period, at least over the last couple of years, as far as banks is concerned, and valuations have kind of been steadily dipping down. I think we continue to at least keep confidence in the fact that book value can continue to compound at about anywhere between 12 to 15% for most of the banks, even in the next 2 years. Even keeping in mind the possibility of pressure on NIMs or profitability in general. So I think if we are set up for a decent credit growth in the system, we should be able to track that kind of book value growth. And then, as you rightly mentioned, now valuations are no longer as demanding. In fact, I would say that they are relatively more on the cheaper side. There's a plethora of banks, and we can make our choices. And it gives a fair bit of opportunity to build a decent position out there. So we continue with a reasonably neutral stance, neutral to marginally positive stance as far as banks is concerned. In a more recent past, like as I said, we've veered more towards the domestic side. So within the larger buckets of the market, we have tried to pull in a little more weight as far as the banking sector is concerned.
Right. Tahir, the consumer seems to be not doing all that well, right? Tahir, that's again another indication. So I think we've had numbers from. Okay, I think we'll just have Tahir back with us in a bit from now. Okay, I think we have a bit of an issue as well with the connection. So we'll, Tahir, thank you on that note. Thank you very much for joining us. I had a question, but I guess we'll pick up on that next time. Thank you very much for joining us, Tahir, and great to have you with us here. I think, Sonia, the market's down, 30 points or so, 19,020, but we've got our next guest with us.
Oh, absolutely. The stock markets may be under pressure, but the real estate markets are doing pretty well. Macrotech Developers is on our radar now. They've achieved 48% of their pre-sales guidance for FY24 already. The company's pre-sales have surged 12% year-on-year. Collections have also surged, while the net debt has come down in Q2. Abhishek Lodha, the Managing Director and Chief Executive Officer at Macrotech Developers, is joining into the conversation now. Abhishek, thanks a lot for joining in, and happy to have you here on CNBC-TV18. This is a good time for most real estate companies, and for your own company, you've achieved almost 50% of your pre-sales in FY24 already. Are you on track to achieve the full year guidance of 14,500 crores? And what are the demand trends looking like now?
Good morning, Sonia, and a very happy early Diwali wishes to you and all the viewers. The real estate cycle, as I've said several times before, we are in year 3 of a very long 15-ish year cycle as India moves from being a low-income to a mid-income economy. And we're seeing that play out quarter after quarter. So as you mentioned, we are now close to 50% of our pre-sales guidance. We feel we are very much on track for our overall guidance of 20% growth from last year's number to get to about 14,500 crores of pre-sales. And generally, one is seeing that the consumer understands the fact that housing is going to be good quality housing is short supplied in our country. And consumers realize the very important role that housing plays in their lives and the lives of their families. So we see the need for people to upgrade. As you may have noted, our pricing YTD increase is at about 3%, which is again in line with our overall target to keep price growth below wage growth, so that while people upgrade and get into new homes and see nominal price growth, it's below wage growth, so that affordability keeps increasing and more people can afford a better quality home. Generally, we feel that the market's in a steady phase. We see this compounding in terms of pre-sales as well as good affordability continuing for a longish period of time. And while there will be blips along the way, generally the housing market for the big players who deliver good quality product and service is in a good space.
Okay, all right. Hi, Abhishek. Good morning. Take that point on board. So you're appearing reasonably confident about achieving those numbers. And as you said, price increases have been 3%, but you're looking at that very, very closely to keep affordability as well in check. Let's talk about cash flows, though. For the first half of the year, I think cash flows have been around 2,100 crores odd. The guidance for the year was around 6,000 crores. Do you have more launches in the pipeline? Tell us how you go about that.
Nigel, morning. As you know, the housing industry tends to be seasonal on a quarterly basis. Q2 is generally the weakest quarter of the year because you have the monsoons, especially in Mumbai, and sometimes you also have the inauspicious period of Pitru Paksh, which this time is in Q3. Having said that, we feel quite confident about our overall free cash flow generation. As you would have noted, in spite of being having achieved 80% of our business development growth in Q1 itself, we are at about just under 15,000 crores out of a 17,500 crore target. We've still managed to reduce our debt in the first half, and we continue to focus on continually reducing leverage and getting it below our stated objectives of 0.5 times debt equity and 1x of our operating cash. And we expect our operating cash to be around that level that we guided earlier of 6,000 crores.
Abhishek, hi, good morning. I just want to pick up on that cycle point that you made. You said we are in year 3 of what is, you called it a 15-year cycle, but that is India becoming a middle-income country cycle. But we are in what year of the real estate cycle? Because the real estate cycle will be broken up within that 15-year cycle, right? So in that sense, where are we?
Morning, Prashant. I think, you would have seen this play across many different countries. As a country moves from low income to mid income, you get this once in the lifetime of a country cycle where housing becomes secular structural growth story for 15 to 20 years. You saw it in the US after the Second World War from the mid 40s to the mid 60s. You saw it in China from the late 90s to the 2015 or so, and you've seen that cycle play out in many countries, because when a country moves from low income to mid income, you have a large number of households who were earlier not home ownership capable now become home ownership capable, and at that time the demand is substantially more than the supply can match, and therefore the usual cyclicality of housing, which is more like 5-6 years, goes away, and you get a much longer structural growth cycle. And we feel this is that time in India's economic trajectory. And therefore, we are only in year 3 of this housing super cycle, which will be, in our opinion, 15 years or thereabouts. There may be, blips along the way, because if there are macroeconomic challenges, which will inevitably come in the next, in this 15-year period, there will be blips. But generally, we see supply, and especially good quality supply, being lower than demand, and therefore this cycle being quite long.
You don't see, so you've obviously, sort of thought this through, and you've seen previous cycles as well, but there's no risk of in a way, I don't know how else to put it, but like a blowout top, which then kind of, leads to stagnation for some time, overbuilding, overinvestment, which then needs to be corrected over many years. You don't see the risk of that, especially here in Mumbai? Not just you, but the sector.
Prashant, our view, as I said earlier, is that supply is far below demand. The thing that we have to watch out for is that pricing growth should not become excessive, because in India, ultimately, we are talking about more and more people being capable of affording a home, which is what is going to drive this super cycle. And that's why, as a company, we've continuously said that we want to keep price growth below wage growth so that affordability keeps getting better. As long as that is the case and people don't get over ambitious on price growth, we will see the cycle being quite long.
Okay. I want to understand, Abhishek, also what the plan is in other markets. Currently, you don't have too much of an exposure, whether it's in markets like Pune or Bengaluru, but you have a plan to take your market share up there by the end of this decade. Tell me a little bit about the near term, right? What are the new launches in some of the newer markets that you're looking at, and how do you plan to, raise market share there?
Sonia, 2 years ago, we had about 400 crores of sales in Pune. For the year ending March 23, that was 1,200 crores. And this year, we expect to cross 2,000 crores. So we are clearly moving towards being, amongst the top 2-3 developers in Pune. And we should be in the top 3 by the end of this year and hopefully then get even bigger from there. Bangalore, as we've said earlier, we are in our pilot phase. We are hoping to have our first launch in Bangalore in the month of November, which is just a few days from now, and that's going to be the start of our journey in Bangalore. We expect to take 3 to 4 years in delivering our product and establishing our brand and establishing our local operating capability and team before we scale up in Bangalore. So for the next 3 years, it's about Mumbai and Pune. First half of the year, we generally keep launches low because of the monsoon unpredictability as well as certain inauspicious periods. Second half of the year, we have, almost 7 new locations that we'll be launching compared to just, 2 in the first half of the year. So that is going to give added momentum to our sales trajectory. But generally, the new cities, as we've seen, we've ramped up quite rapidly in Pune because the demand for good quality product from a strong brand is very, very high.
So you said your Bangalore launch will be, the first launch is in November this year, is it?
Yes, Sonia. So in a few days from now.
Okay. All right. Abhishek, the last time we spoke, you were telling us about the facility management service and how that business, is gradually seeing a bit of an uptake. Tell us about your annuity income. What do you end this year with, and where do you see that number headed?
Nigel, we have 3 prongs in which we are building annuity income, and we are doing that with a view to not go far away from our ROE targets of 20%. We have our digital infrastructure platform where we're building warehousing and industrial across the country. We have facility management. And then, of course, we have select office and retail locations. We expect to end this year at a run rate of about 250 crores per annum of annuity income. And we expect to grow that by fiscal 26 to about 500 crores of annuity income. And by the end of the decade, about 1,500 crores of annual annuity income.
Okay, Abhishek, we'll leave it at that. Thanks a lot for joining in and taking us through your numbers. All the best for the second half of the year and, for your new launches, especially in some of the newer markets. That's Macrotech Developers. They've already achieved almost 50% of their pre-sales guidance, and they hope to meet their full year guidance by the end of FY24 in terms of pre-sales. The stock is up almost 4.5%. The street definitely likes what they heard. Let's slip into a quick break. On the other side of the break, we will have Ramesh Iyer, the Vice Chairman and Managing Director at Mahindra Financial Services. That's one of the big stocks under pressure this morning. We'll discuss more on their second quarter earnings. Later, we'll have V. Vaidyanathan, the MD and CEO at IDFC First Bank, to talk about their quarter 2 performance. Stay tuned.
Welcome back. Well, the markets have taken a bit of a downtake as we speak, and the advanced decline ratio as well is firmly in favor of the number of stocks that are declining. What's doing well actually as of now? Cipla, that continues to hold well in the green. Tech Mahindra as well is up and about, and big boy Reliance Industries. I'll tell you what, that's holding one end up. If not for Reliance Industries, we would have easily been down closer to 90 to around 100 points approximately. So Reliance Industries is holding forth, particularly with the Nifty Bank trending lower yet again. Last week's low is around 42,100 odd. So you'd want to watch that mark on the downside. Auto stocks actually are coming for some profit taking. Whether it's Tata Motors, whether it's Maruti, both of them are under some pressure as we speak. But let's talk about the big mover from the broader markets actually. We have Mahindra & Mahindra Financial. That's a stock on our radar. The earnings came in lower than what the street was working with, the net interest margins coming in at 9-quarter lows. Their asset quality as well has worsened a tad bit, and that's what led to the profitability decline. Mr. Ramesh Iyer, the Vice Chairman and Managing Director at Mahindra & Mahindra Financial Services, joins us to give us his insight into the quarter's numbers. Hi, Mr. Iyer. Good morning. Thanks so much for joining in. Well, the pain point has to be on the NIMs, right? Could you tell us the incremental cost of funds? What's it coming at if it compares with what you're currently borrowing at? And what does it mean in terms of NIMs from here on?
So in terms of our current borrowing is concerned, it's about 7.4, 7.5. But, the real concern is we expected the borrowing cost will come down post-festival, and we had talked about it earlier in the first quarter or before that. Unfortunately, that is not to happen. And we had not pushed up our rate, thinking the rates would come down. But I think now that the clarity is that by March it's not coming down, surely our lending rates are going to go up. We are pushing up our lending rates. That's one. Second is, the pre-owned vehicle, the availability is still an issue, and they come at a better yield. And if that was to happen, the NIMs would have looked different. The third is there is a prime segment which we consciously have got into, and they come at a lower yield, but they also come at a lower cost of operations as well as lower credit cost. So we are clear as the rates move up, and then of course, at least next year for sure, the rates will come down. We are confident that by March, we will move to a 7% NIMs. And then going forward, if the borrowing cost has to come down, you will see further improvement.
Mr. Iyer, hi, good morning. There was a bit of a spike in credit costs as well. Slightly higher than what we saw in the first quarter. Could you explain that, sir, and what's the outlook?
So if you look at our provision cover has also gone up from 60 to about 61 point odd. This comes by a formula of the LGD. Otherwise, if you look at our GS3 and GS2, GS3 has remained stable and GS2 has actually come down. So there is no pressure on the asset quality. It is just the provision number which has gone up. And if you compare it with the previous quarter, last year's second quarter, it's because last year's second quarter had a provision reversal, which is not there because that time our NPAs were elevated and you got a benefit of the reversal. So we don't see a pressure on the asset quality front, while you do see about 100 crores increase that has happened, and that's purely by LGD. And there has been a little increase in our collections from the tractor front, which has actually got postponed from September to October. It's just a 1-month shift which has happened, and you will see that change in this quarter.
Okay, that delay in collections was largely because of that, the rainfall issue, right? Because of which the tractor segment saw.
Delayed monsoons obviously pushes some of this. And then now that things have stabilized, we have already seen them come back.
Okay, so what does that mean for the gross NPAs as we move into the next couple of quarters? If you're saying that this is just a 1-2 quarter phenomenon, then do you see any recovery? Your gross NPAs are almost 4.3%. What is the outlook for the full year?
No, so 4.3 is lower than what it was in March. It's never the situation when it comes to the first half. And we have a 60-odd% cover already that we are carrying. And clearly, with the improved cash flows that we would see in the next 2 quarters, I think we would see improvement to this number further from here. Second way to look at it is if you look at our stage 2, they have been showing declining trend, which means there are no forward flows that are happening. I think put the two together, clearly we have visibility for the stage 3 numbers to be lower than where they are.
Okay, all right. Give us a couple of numbers, Mr. Iyer, on the NIMs. You were telling us you're going to be, repricing some of your loans. So tell us, what should the NIMs look like? And also credit cost, I think it was around 1.7, 1.8%, but you're guiding that it will come lower towards the end of FY24. So both these two numbers, NIMs and credit cost?
So as far as the NIMs are concerned, we'll first move to a 6.8 maybe this quarter end, and then we expect by March to touch 7% as far as NIMs are concerned. And in as far as the stage 3 is the credit cost is concerned, as I said, this quarter and the next quarter are the great quarters from a collection perspective, and which is why we've kind of guided to say it'll be anywhere between 1.5 to 1.7 as far as the credit cost is concerned.
Mr. Iyer, there was, I think we've spoken about this earlier as well, that should one expect, what can lead to a more kind of sustainable kind of performance? Because there's a fair bit of seasonality. There's a fair bit of up and down in the earnings trajectory in that sense. Is there any way, what can you do to reduce that volatility, sir? Because that is what the markets are also unhappy with.
So one of the action very clearly is that we have got into a segment of customer, which is the prime segment, which, as I said, comes at a little lower yield, but they are expected to be more stable in terms of the credit cost is concerned. Till such time, we have a book which is more of a earn and pay segment. I think you will see this volatility, but that book is slowly running off, and we are adding the new set of book to that, which is the Primex and the pre-owned vehicle segment. I think what you would see is already you're seeing in stage 2 and stage 3 a stability. I think the provision stability will start happening because it's at the end of the day, an ECL model which takes the last 42 months into account when you put that into the formula. Once we have the old book slowly run off, which will be another 2 quarters or so, you will see this completely stabilize.
You were telling us briefly about the tractor loans and how there was some delay in collections, etc. What about the other segments that you cater to, right? Whether it's UV loans, cars, pre-owned cars as well. Are you seeing any kind of pressure over there at all? And what is the prognosis over the next few quarters?
I think we're seeing no pressure. Even in tractors, it was very, very temporary 2 weeks delay. When you have a half-yearly installment collectible and they get shifted by a month or so, you have this kind of an impact. As otherwise, on an overall basis, we don't see, and that can be seen from our disbursement numbers as well. The demands are holding up, the sentiments are positive, and I always said this, that when you see demand for the vehicle, it's nothing but the underlying cash flow is what it speaks of, and you also see in our collection efficiency. So we don't see any negative sentiments out there. The Dussehra festival that we just saw was phenomenally good from a retail perspective, and so seems to be the Diwali.
Okay, all right. Mr. Iyer, disbursements have been good, but it's not really translating to AUM growth. So tell us what's the guidance on that front? AUM growth, say, for this fiscal as well as the next?
But why do you say that? We have a 27% growth, and I think that's a very healthy growth over the previous. And we do expect that by March, you will continue to see AUM growth upward of 20-22%.
Upward of 20-22%. Okay, got that. Finally, the housing finance segment has remained weak for the longest time. Can you tell us what's happening there? There's been a lot of disbursals in Q2, but there's been no AUM growth in housing finance particularly. And even the asset quality is on the weaker side. What's the outlook and how long do you think it would take before recovery comes through?
I think we've talked about it in the past. Clearly, we are now moving towards affordable as one of the key segments for the book. And you will see it in the next 3-4 quarters that the affordable lending is higher than the rural lending. And the rural lending is running off faster because the assets are maturing, and which is why you don't see an AUM growth while you see a disbursement growth. But no sooner we get into at least about 30-40% of the book come from affordable, which are long-term, you will see the book growth as well beginning to happen. And the strategy there very clearly is while to stay in rural high-end, but it's also important to get into the affordable piece. And in the next year or so, you will see close to 50% of the book come from affordable housing.
Okay, Mr. Iyer, thanks a lot for joining in. And, the stock is under a lot of pressure. So hopefully things improve both in your core segment as well as in the housing finance space. That's M&M Financial, the biggest loser right now, almost 10% lower. But the other stock that we are looking at this morning is IDFC First Bank. Their business momentum is quite strong in Q2. Deposits have surged. Advances have also seen a healthy jump. Their margin has been stable, but the slippages have increased and the cost of funds are elevated. V. Vaidyanathan, the Managing Director and Chief Executive Officer at IDFC First Bank, joins in. And we have Lata Venkatesh joining us in the studio to take the discussion forward as well. Lata, over to you.
Thank you, Sonia, and thank you, Mr. Vaidyanathan, for joining. As Sonia rightly, introduced the topic, deposits and advances growing at 33% year-on-year positive. Can you give us some more details on the cost of deposits?
First of all, deposits have grown by 44%, just for information, and loans and advances have grown by 25%, just to get the numbers out of the way. And in terms of cost of deposit, let us just continue the discussion. I'll ask some of my colleagues to feed me the number while I continue the discussion. But we'll disclose before the end of the discussion. Yeah.
No, sorry, I didn't get you. You're not telling us the cost of
No, I will tell you.
Deposits?
I don't have the number offhand, but my colleague here will give it to me. You just continue before the discussion ends, my colleague will give it to me.
Okay. No, I'll tell you why. For me, it is the key number because your NIMs are very good at 6.338 or something, right? It's 6.32 versus 6.33 in the previous quarter. It's a very strong NIM compared to other banks. So I wanted to know what is the average return you get from assets? Because when I look at your deposit cost, you are even in your savings deposit for 5 lakh plus you give 7%, for 1 lakh plus you're giving 4%, which is more than other banks. So, I mean, that's why I wanted to know your cost of deposits because plus the margins, it looks like your yield is very high. Your yield must be something like 13%.
So, Lata, I got the number as I spoke to you. I told you my colleague was giving it to me.
Okay.
So, it's a 6.1% is a cost of
deposits.
So, to your question, therefore, what we've done, Lata, in the last quarter is that we have brought down because the deposit numbers are so strong coming at 44%, what we did is we have reduced our savings account interest rate to only 3%, up to 1 lakh rupees. As you know, we were paying 7% earlier, but we brought it to 4, now we brought it to 3. So we feel that since the deposit prices are so strong, in due course, we can continue to bring down the cost of deposits for the bank. And then correspondingly, of course, the yield also will come down.
Okay. So, if your cost of deposits is 6.1, I mean, I assume this is a 1-year average, or is it average for the second quarter?
For the second quarter, all composites put together. It has, current account.
Okay. So if you add 6.1 and a margin of 6.3, your yield on advances should average something like 12.5%, 13%.
But that's not too much. I don't know why you're so surprised with that. Have you ever asked your friends, the large NBFC Pune best friend, what is
No, I'll tell you why the worry is. The worry is because Reserve Bank is repeatedly, giving us warnings of unsecured debt. So that is my worry. Are you in a high risk, high return kind of loans? Is my doubt.
No, it's not your doubt today. It's been your doubt for 13 years now, by the way. So your doubts never go away. But let me just say that the way we look at it is that this is the Reserve Bank of India's commentary about unsecured is a very real thing, and we should pay very close heed to it. Just to share the numbers with you, our average NPA, I'll talk credit cost separately, but our gross NPA for this whole book is 1.53% and net is 0.53%. And I want to read out, since you're so particular about this, I'll read out the numbers to you and that will help you actually. The consumer loans business, our gross NPA is 1.96%, net is 0.52%. In vehicle financing is 1.76%, it's 0.73%. In gold loans, digital loans, its gross is 1.58 and it is 0.39. The SME loans is 1.42, net is 0.47. The home loans is 0.89, 0.39. And rural finance is 0.68, 0.15. This is very material why I read out to you. I don't mean to consume your time. I want to tell you that product after product, we maintain gross and net very low. So it is not about the yield. 13, 12.5, 13 is pretty good, right? The important is to maintain asset quality, and you should respect the fact that for a long period of time, like extended period, through cycles, this is our gross and net NPA.
Okay. No, the Reserve Bank is not worried about NPAs now. They are repeatedly saying that NPAs of banks and NBFCs have been falling. So that point is taken. Their worry is about when the cycle turns, whether we are getting into a difficult position. That's why I am asking you, what is the percentage of unsecured loans?
So this is an important question, Lata. See, the main thing is that we have tightened all our credit norms across all products, just for information. because we heed signals from the marketplace. We saw every other day there is a report in the newspapers where the regulator is cautioning people. We have taken it up to our board. We have shared with the board what I described to you in a much more granular level, product by product, segment, tenor by tenor, to our to our risk committee, to our board, and we share everything with everybody, including the markets. So just want to tell you that we are tight on the norms. The first thing
your investor presentation has that 10 steps for underwriting. I mean, I read your investor presentation thoroughly. I'm not saying that, but if you can give me the number, how much is unsecured debt? Since Reserve Bank is raising the ire, we're asking this to all banks.
Yes, of course. See, the thing that if you have noticed from the marketplace, the key area to bother about, at least in the market, not in our book. I read the numbers to you, secured, unsecured, they're all doing well. But from the market point of view, you saw the bureau report which said that less than 50,000 rupees is where they said there could be trouble developing here. So we went and studied our own book because we don't play in that segment at all. So give the idea specifically in the numbers, if that helps you. That number is 530 crores for our bank, 540 crores. Our entire exposure in that segment, less than 50,000, 540 crores. And our entire loan is 1,80,000 crores. So 540 crores divided by 1,80,000 crores is 0.3%. So we don't play in that segment. It's really, we don't have the book in the first place. And by the way, whatever it is...
No, I take your point, sir. I told you I read your presentation thoroughly, and I saw that 540 crore of under 50,000 rupee loans, not taking away. And in fact, CIBIL also says that the overall bank exposure to under 50,000 is 0.3%. Even for the industry, it's only 0.3%. But I'm asking you, the Reserve Bank's worry is also about generally unsecured loans, as a category. So what is the percentage of your unsecured loans, and how is it fared quarter on quarter, year on year?
So let me answer the second question first, because it's more important than trend line. If you take, from 2018 onwards, the time of merger to today, our retail unsecured credit, by the way, I've described it before to you, we don't, in the way we practice it, we take cash flow. So it's a cash flow lending. So keep that picture in mind, we'll talk about it later. So that number trend line has been continuously stable or dropping for us to take a period of 4 years. So that's a short question. But in terms of specifically what is the percentage of this, etc., this is not a number we put on public domain, so I really can't share with you specifically to your channel. But I must tell you that for you, to your investors, to your viewers, I can very clearly say that the so-called unsecured book, which is supported by cash flow, it is performing better at a lesser delinquency than the secured book, both in gross NPA and net NPA, if that gives you comfort.
Okay, no, I did my own math going by the pie chart that you gave, and I got something like 23%. Is that correct? Your digital loans, education loans, consumer loans, I mean, whatever looked like uncollateralized. Would it be about 23, 24%?
Well, you're a good researcher, so you've done you've done a fair amount of work, but you could be somewhere in the ballpark, yes.
Okay.
But maybe a little lesser than that. But our sense is, I want to just, since you flagging so particular on this front, we have 2 points to make to you, because particularly since an important question you're raising, it's very important for me to answer it correctly.
Yes, please.
For viewers to understand. There are 2 kinds of unsecured loans. One unsecured loan is where you don't evaluate the cash flow and you lend money. Like think of a credit card. On the other hand, there is a product which are normal term loans, unsecured, given to customers, whether they are personal loans to individuals or to businesses, or retail basically, where we evaluate the cash flow and we trap the cash flow, and we can't say trap the cash flow, but we take the debit the bank account. So if you, for example, have a monthly salary credit in your case of say X lakh rupees, let me call it 10 lakh rupees, and then let me say that if your installment is say 2 lakh rupees, we know it will clear. So we make sure that we track the amount of credit getting and ensure the yield lesser than that by a margin, and we take a debit instruction to the bank account. So this is a very important point for people to know why our unsecured credit is behaving well. It is not unsecured credit, it is secured by cash flow with the right to debit a bank account. Just want to clarify that.
No, I certainly, your presentation is saying that you have taken a lot of, a lot of these safeguards. But nevertheless, there are a lot of people who have 4 or 5 loans. That's another data put out by Sibyl. And therefore, if those guys also have an auto loan, that's where it hits the banking sector. Because they may have 4 or 5 loans with fintechs and BNPL and all that. And if they also have another loan, which the banking sector can be hit, the Reserve Bank explains that's what worries them. Otherwise, they are pretty, okay about the banking sector.
Lata, Lata, don't switch subject without listening. The thing is that those concerns are very valid, first of all, because we have to be very careful in this segment, and we've done this for 14 years in a row, and we continue to be very careful. I told you, we share everything with every committee, everybody, everything. But more importantly, on the multiple loans issue, I want to just share with you that at the time of sanctioning of a loan, you consider all the EMIs paid by the customer before you lend to the customer. The issue, I'll tell you where it is, just so that you know where it is. This segment of the lower segment of the less than 50,000, where people are taking money on the fly and using it for holidays, etc. This is more a let me say fintech apps that are doing this kind of lending, and who basically say, put this 5 data point and take my loan right now on the fly.
Yes.
Because they're not doing cash flow assessment. They're just doing app lending. And number 2 are the maybe NBFCs, smaller NBFCs who play in that segment. The best of my knowledge, banks are not playing in that segment. Banks don't like the 50,000 segment. We don't like that segment either. That's the thing.
Yes. Yes. I mean, that's very clear from your numbers. You've made it very clear. Out of time, sir, but we will invite you for a more relaxed chat. Thank you very much, Mr. Vaidyanathan. That's very strong numbers in terms of deposit and margin growth. Congratulations.
Thank you.
Over to you, Sonia.
All right. Thanks a lot, Lata, for that. And thank you, Mr. Vaidyanathan, for joining us and taking us through your numbers. By the way, the market is taking a turn for the worse. So let's get our focus on that. The Nifty is now down 85 points. The Sensex is down almost 300 points. It's moved to the lowest point of trade. It is weak global cues along with, pressure coming in from several areas, whether it is the higher bond yields, there's the US FOMC meet later in this week. So all of that putting pressure on the markets right now. And Mitesh Thakkar is joining in. Mitesh, that bounce that we saw, a little bit of a bounce on Friday has been sold into. So clearly this is a market whose texture has become very weak. But at this level, below the 19,000 mark, how are you looking at it? Any fresh shorts that you'd want to take?
So, we've been advocating buying into put options and suggesting people to short aggressively in case the Nifty gets closer to 19,200, 250 zone. I think that's the approach we'll take. And I believe that there is a stronger chance of us breaking below Thursday's low, which is 18,837 and 18,600, 620, which is the 200-day moving average zone. I think that could be tested. Having said that, I have one buy and one sell right now. Britannia is something which is possibly, breaking down below a consolidation. So would recommend a sell here. Keep a stop at about levels of 44.90. Look for targets of 43.50. And on the buying side is GNFC, which is doing well in a weak market. So buy here with a very tight stop at 660 for a target of 692.
All right, thanks a lot for that. Not looking good at all. By the way, there's a new listing. Max Estates has listed at 298 rupees a share versus its issue price of 216, so doing pretty well. We'll get you more on that, but don't lose sight of what's happening in the broader markets. There's a deep slide right now, almost 250 points gone on the mid-cap index. When we come back, we'll shift focus to the commodity markets. Manisha Gupta will be with us, and we'll also try and get you some of the big stocks that are on the move this morning. Stay tuned. Well, it's not looking good actually for the market at all. In fact, the Nifty is well below the 19,000 mark now. But let's get a handle on what's happening in the world of commodities. Manisha Gupta is joining in. Manisha, what's the one commodity that you're tracking today?
So now I'm looking at the gold prices because we've seen 3 weeks of constant gains into this one, and this week as well has started on a positive note. We actually did $2,009 an ounce in the earlier trades, but we still are holding that 2,000 of a magical psychological level at this point as well. The last time you saw 2,000 was in the month of May when we saw prices go all the way to 2,050 as well. But we are looking at strength coming back because there is still chaos in Middle East. And remember, the gold prices have hit all-time highs in various currencies in the month of October itself, including Australia, Taiwan, Japan and China as well. And it was in this year itself that we saw all-time highs come in for the Indian currency too. Markets are looking at strong support because of the geopolitical tension, so there is safe haven because of that. And then you also are looking at funds buying, even as we have seen the bond yields trade near those 16-year highs. Well, high trading volumes, and we have seen on back of that continued buying as well. China gold consumption also has seen strong strength, up by nearly 7.3% for the year 2023 until now. Also, when you look at the India fourth quarter sales, this is the highest selling period or quarter within the Indian markets there. And the expectation from the street is that you could be looking at 10 to 15% of a jump up when it comes to gold physical buying there. So all of those factors quite supportive. I also want to show you on what gold prices have done in this year. We started the year at $1,823 an ounce. We saw a high of 2,051. That was in the month of May. In the month of October itself, this is where we are trading right now. We started with 1820 of a low, and we are trading at 2005 right now. So it has been a strong $200 of a jump up coming in case of the gold prices within the month of October itself. If you look at the last 1 year, the gold prices have gained up by 20%. Very less other asset classes can actually, boast of that. So strong gains coming in for this one. As has been the conversation, a lot of data coming in this week. You have the US Fed meeting, US non-farm payroll data, and monetary policy meetings from Japan and England as well coming in. I quickly want to also take you through on what the street is watching out in sense of gold projections going forward. So the most conservative actually comes in at 2,050, which is a high of this year in any case. Goldman Sachs is talking about 2,133. ABN AMRO, Citi and Saxo Bank are talking about levels between 2,000 to 2,200. Actually, that really seems to be the band where most banks and brokerages feel that the gold prices will trade going forward in 2024. But you also have more bullish cues coming in, especially from Wheaton and Livermore, who are also talking about $2,500 per ounce on the higher side coming in for the gold prices. So every bank, every brokerage, every financial institution that you speak about are quite bullish on gold.
Okay, thanks a lot for that. So bullish on gold, especially during the geopolitical crisis in a market that is risk averse towards risky assets like equities. Thanks a lot, Manisha, for that. Let's talk about some stocks that are on the move. First up, we have MGL in focus. Sonal is tracking that for us. Sonal, over to you.
Thank you so much for that. Well, the numbers have been decent and better than some of the estimates. And the volume picture is something that the street is very bullish on as well. The revenues, they were up 2%. Yes, there's a decline in EBITDA, down around 8% and marginally lower than what the CNBC-TV18 poll suggested as well. Margins have come in at 30.5%. Profits are down 8%. However, the volume picture looked good for the company. There has been an increase both on a quarter-on-quarter and on a YOY basis. 3% up YOY, 5% up sequentially. And this was led by their CNG volumes, which are higher by 4% on a sequential basis. PNG volumes, however, slightly muted, down 1% on a sequential basis. But most of the brokerages, they have given a thumbs up. In fact, Citi says that it was a strong quarter. They have a buy rating with a target price of 1240 rupees a share. They say it was led by a volume beat for them. In fact, the EBITDA margins were also higher than what Citi was anticipating. If we talk about their EPS, in the first half it stood at 72 rupees per share. This, they say, will create room for healthy dividend payout this year. So decent numbers and a possibility of healthy dividend payout is something that the street is lacking for MGL.
Okay, thanks a lot for that. AU Small Finance Bank is the other one that we're looking at. Abhishek is tracking that for you. Abhishek, what are you looking at today?
AU Small Finance Bank, in terms of numbers, slippages have increased in absolute value by more than 10% quarter-on-quarter. Gross NPA ratio has inched up by 15 basis points to 1.91% versus 1.76%. Net interest margin is at 10-quarter low, and net interest income growth is about 15.3% YOY and about 0.2% sequentially. So it's the other income which has helped the PAT this time around. Provisions are elevated on account of increase in slippages that you have seen. PAT has come in at at 402 crore, up 17.3% YOY and about 3.9% sequentially. They have also announced, their intent to acquire Fincare Small Finance Bank. They will give about 579 shares of AU Small Finance Bank for every 2,000 shares that is there in Fincare. This acquisition will increase, AU Small Finance Bank loan book by more than 16%, and it gives them a huge presence in southern states like Andhra Pradesh, Telangana, Tamil Nadu, as well as Karnataka. Back to you.
Okay, thanks a lot, Abhishek, for that. Let's take a quick break. On the other side, Lata will get chatting with Nitesh Ranjan, who's the Executive Director at Union Bank, to discuss their Q2 performance.
Welcome back. Union Bank of India has reported a very strong set of numbers. We have seen the net interest margin at some kind of an 8-year high. Very good net interest margins, largely because provisions have, started to decrease. The high write-offs, of course, have improved asset quality. The slippage ratio also is at an 11-quarter low. So in terms of asset quality, very little to complain. Nitesh Ranjan, Executive Director at Union Bank, is joining us now. Mr. Ranjan, good morning and thank you very much for joining us. First up, if you can tell us, you're moving to a new tax regime. So you all are expecting that your return ratios are going to improve?
Yeah, good morning. We are planning to move to the new tax regime during the current financial year. There was a load of the deferred tax assets, which we have taken care of almost by the Q2 of this year. And now when we move to the new tax regime, that hit will not be there on the balance sheet. So effectively from close to 35% of tax rate, we're moving to the 25% of tax rate, which will obviously will help us in improving the ROA further.
Okay. If you can tell us a little more about asset quality or recovery. Are you seeing, I mean, your GNPA still at about 6.3 is higher than most other banks. It's on the higher side. Are you expecting good recoveries from loans already written off?
Yeah, as you said, Union Bank is reporting most of the numbers, which is kind of decadal high, including the asset quality. So this year we have given a guidance of bringing the gross NPA to below 6% and NPA below 1%. And in both the numbers, you can see that we are trending towards that. And by the end of the year, we are sure that we'll be achieving that guidance. And overall recovery, if we look at, we have a guidance of around 16,000 crores of recovery during the current year. And in the first half, we have already recovered close to 7,800 crores. And we are hopeful that like last year against the target of 16,000, we recovered 20,000 crores. This year's also recovery should be much more than the guidance of 16,000 crore that we have given.
Okay, so we can expect some 9,000 crore at least in the second half?
Yeah, sure.
Okay. What about provisions? Even that's been coming down. Can you give us some guidance on how much they can come down and therefore how much your credit cost can come down? It's already below 1%.
Yeah, so credit cost also, it is coming down now. It is around 80 basis points, which is close to 50% lower than the previous year. And the cost of credit cost for the seasoning requirement is very less now. So going forward, actually, the credit cost should trend towards 0.7, 0.75% kind of thing for the whole year. That is our expectation.
Okay, so you can expect stronger earnings and a lower cost to income in the second half compared to the first half?
So if you look at our cost to income ratio, we have been in the range of 43 to 44% for many quarters now. And we believe that the kind of business model that we have built, we should continue to maintain this and in fact move towards the lower level of cost to income ratio also. We have taken many structural initiatives in the bank which will further reduce the cost.
Okay, okay. You know, your annualized credit cost is 0.97. What is the annualized credit cost now?
So annualized credit cost for the Q2 will be around 80 basis point, 0.80.
Okay. All right, leave it at that. What about growth, sir? You know, there is no denying that quality of the book is very good, but growth is not coming at the rate at it is coming for the banking average, both in terms of advances and deposits. So first, deposits, what is the cost of deposits and what is the pace at which you can grow it?
So this quarter, the deposit growth has been close to around 9%, led by savings growth of around 4.5%. And this is close to the guidance that we have given for 8 to 10% deposit growth for the current financial year. So we are growing, and you know, what we are doing is we are not taking excess deposit. In fact, even if you look at our bulk deposit, the certificate of deposits, actually we have brought it down from the March 23 level. That is only with the objective of reducing the cost of fund further so that we are able to maintain the higher NIM. On the advances side, if you look at again, while our guidance is around 10 to 12%, we have grown this quarter around 9.5%. And within which the RAM segment, all the three retail, agri and MSME have grown close to 14 to 15% range. On the sequential basis also, if you look at current quarter, we have grown around 3.5% in the loan book. So loan book is pretty healthy, and particularly few segments in that, like the gold loan, education loan, growth rate is pretty good, and we are sure that we'll be able to achieve the guidance level of 10 to 12%. And the Q2 number also, I'll say that when we look at the loan growth of around 9.5%, there is some base effect also. You'll recall that in September 2022, we were growing at close to 22% YOI in the loan growth. So there is some base effect also. But on a half-year basis, the growth is in line with the guidance.
Okay, it is still lower than the banking average. Banking sector average is running at 15-16%. So compared to that, even your guidance and your actual performance at 9% is lower. Are you confident that for the full year you will get to 12%, or can you even do better?
Yeah, sure. So 10 to 12% is the range of guidance for us, and we'll definitely be achieving that. As I said, that will be led by the growth in the RAM sector, which is continue to grow 14 to 15% range YOY quarter after quarter. On the corporate book also, as we speak, we have close to 40,000 crores of term loans already sanctioned and yet to be disbursed. So some part of that disbursal will come. We have close to 40,000 crores of line of credit available with us, which will happen. Some part of that will happen in Q3 and Q4. On top of that, any point of time, we have 30 to 35,000 crores of new proposals under consideration. So all this together, I'm sure that the guidance level of advances that we have given will be able to achieve.
What is the percentage of unsecured loans?
Unsecured loan for us is close to 1.4% of the total book. And that is doing pretty good, actually.
Only 1.4%, but I thought you said that your retail and SME, retail, agri and MSME is doing very well. The unsecured book is only 1.4%.
Yes, unsecured book as a percentage of total loan book is 1.4%. And
as a percentage of
the retail loan book will be close to 7%.
Okay. And what is the rate of growth there? I mean, I'm only asking because the Reserve Bank is worried about those areas. What is the rate of growth of unsecured retail?
So the unsecured retail loan for us is growing close to around 35% YOY basis. But the base is very small and our exposure is most to our existing clients, who are mostly the salaried clients of the government PSUs or the good private sector companies.
Okay. At the moment, your ROA is 1.07%, right?
Yes.
And by year end, you will be, what kind of an ROA can you report when you take to the new tax regime?
So interestingly, we had given a ROA guidance of 1% for FY25, but we have been able to achieve that in Q1 and Q2 both together. Current year, our estimated that we'll be able to just above 1% of ROA. And when we finally move to the new tax regime, maybe another 5 to 10 basis point gain could be there in the ROA.
So that will be what,
1.05
or 1.1? Sorry. For the time being?
For the current year, we are keeping the guidance of 1%.
1%. But with the new tax regime, it can go to 1.05 or 1.1. What's likely?
Yeah, 5 to 10 basis point increase could be there.
Okay. And can you similarly give us about ROEs? Where is it now? What's the target you're working for the full year?
So ROE guidance, generally, we have been given in the range of 15 to 17%. Currently, we have reported close to 18% of ROE. And we believe that this is the number, around this number, 1 or 2% here and there, the Union Bank will be reporting the ROE.
Okay. What about net interest margins? I'm sorry, that should have been a more important question. Your net interest margins continue to improve, but for the rest of the banking sector, it started peaking off. Will this be the best net interest margin? Should we see half-year lower net NIMs in the second half?
See, we have given a guidance of 3% margin, but we have been reporting higher than that. What is also happening in the system and with Union Bank of India is that the asset repricing is happening faster than the liability repricing at this point of time. And this is the cycle we have seen from August last year. This has been happening. But as the deposit repricing catches up, I think the NIM will trend towards little lower level. For the current year, our guidance is that of 3%, but I'm sure that at least 5 to 7 basis point higher than the guidance we'll be able to achieve into the net interest margin. We'll also recall that we have raised capital of 5,000 crores in the month of August, and that is also giving some 3-4 basis point jump in the margin for the Q2 that we have reported.
Okay. All right. Good to hear that. Thank you very much, Mr. Ranjan, for joining us with all those details on Union Bank. Have a good Diwali and the second half. Well,
thank you.
Actually,
greetings for you too. Thank you.
Thank you. Well, actually, the second hour of trading is also very good for the markets. We've seen the Sensex and the Nifty now creep into the green, led by some large stocks like Reliance, now up almost 2%. Ultratech Cement is also carrying some of the, doing some of the heavy work. The two Adani stocks, 1.2 and 1.1% higher, Enterprises and Ports. Asian Paints, some of these stocks, and actually even the IT stocks have started to come out and perform. Hindalco is doing well. Ultratech, of course, the expansion news is helping. The Bank Nifty is still struggling a bit. It's still down 0.4. But remember, in early morning trades, it was down 0.8. So markets on a recovery metal. So hopefully, the low for the day has been set. At least the first hour low is being respected. Wrap up on Bazaar. Chart busters will take that action for.